Has this ever happened to you? You find a trade setup that seems perfect. After deep research and analysis, you are ready to set your profit target and your stop loss, feeling a surge of excitement for the potential gains. But suddenly, the price begins to fall, getting closer and closer to your stop loss. And because you have invested so much effort and belief in this setup, you find yourself emotionally attached to the trade. This attachment clouds your judgment, causing you to not respect your trading plan. Instead of sticking to your strategy, as the price gets closer and closer to your stop loss, you lower your stop loss and pray that the market will return in your favor. But the price just continues its downward spiral. And unable to detach yourself from the situation, you drop your stop loss yet again. Before you can comprehend the gravity of your actions, you hit a devastating loss, leaving your trading account in ruins. In today's video, we will take a look at one of the biggest reasons why 90% of traders fail, and that is trading psychology. To be specific, we're going to take a look at 4 rules and concepts that every single trader needs to understand before taking their trade. So without further ado guys, let's jump right into it. So the first concept every single trader needs to understand is something called sunk cost fallacy. Imagine you spent $100 on a non-refundable concert ticket. However, on the day of the concert you have caught a really bad fever and it's pouring rain outside. Many of us might think, well, I've already spent the money, I can't let it go to waste. And so, against better judgment, you decide to go to the concert. The big problem with this might be pretty obvious because first and foremost, you will probably not even enjoy the concert if you have a very bad fever. And even worse, since it's an outdoor concert, you will probably be both wet and cold, and this could make you even more sick. But alright, so how does this relate to trading? Well, let's say you are in the position we talked about earlier in the video, you entered the trade right here, the price started to go in the right direction, but then it started to fall. So at this point right here, where you set your initial stop loss, this is no doubt where you should have exited your trade. Because at this point, you no longer have an edge and the odds is no longer in your favor. So the only wise course of action here is to exit your trade according to your trading plan. But because of the sunk cost fallacy and how human psychology works, many traders, when they are in this spot, start to act irrational. You might think thoughts like, this was the perfect setups, how can it go against me? And I'm already in such a big loss, so let's just wait for the price and hope I can at least go break even here on the trade. But this right here is a recipe for disaster. Never ever do this. Always stick to your trading plan. The sunk cost fallacy is when you don't want to quit something because you have already spent time or money in it, even though it's clearly not good for you anymore. It's like eating disgusting food just because you paid for it. Alright, so rule number 2 you need to understand in order to not be a slave to your emotions anymore is that you need to have a rules-based system. When you're trading, whether you are, day trading, swing trading, trading crypto or trading forex, you need to have a very clear trading strategy and a clear trading plan. And this strategy is the only thing you should use. So let's take a look at the chart right here. We are currently looking at a Tesla chart on a daily time frame. And as you can see, since this point right here, Tesla printed both consecutive lower highs while at the same time we printed higher lows. This is a chart pattern that we call a symmetrical triangle, and as you can see, it looks like Tesla just recently saw a breakout of this pattern. But this right here is just one bullish signal. When we are trading, we pretty much always want to have multiple confluences, or in other words, we want to have multiple signals at the same time that indicates that the price is likely to go up or go in the direction of our trend. So for example, right here, yes, we broke out of the symmetrical triangle, but we want to have some other signals as well confirming our trade. So let's go up here to our indicators tab and open up the volume indicator. And as you can see, if you look down here to the volume bar, you can see that this bar where the price is breaking out is much higher than all the previous volume bars. This means that we are seeing lots of market participants participating in the breakout, which makes the breakout more likely to be a real one. So now we have two bullish variables. But many times we want even more bullish signals confirming our trade. So let's, for example, open up our MACD indicator. This is one of my favorite indicators, and if you want to learn more about the MACD, I highly recommend you guys to watch this video right here. It will be linked up on somewhere in the corner of this video. But we open up our MACD here, and another thing we can see if we open up the MACD indicator is that the MACD, for the first time in a very long time, is seeing strong bullish momentum. You see, we have to go back multiple months here to the last time the MACD indicator was this high. So in this case, we have three multiple variables at the same time happening. This right here is our signal to take the trade. We take our long position. Let's just show, you know, some random long position here. Set our stop loss below the most recent low prior to the breakout. That is a very common way to set your stop loss. And let's set up, for example, 2-to-1 risk to reward ratio here. And let's see how this trade plays out. As you can see, it took a while, but we did reach our profit target, and this was a very clean trade. And what helped us taking this trade is because we had a clear rules-based system. Alright, so rule number 3, and this is probably the most important rule in the whole video, is to train your mind. Your mind is the basis of everything that happens in life, including trading. So it makes a lot of sense to train it. If I had to choose one thing that has made the biggest impact on my trading psychology, it has to be meditation. And by practicing meditation, you will also notice that it helps you in so many other situations in life as well. But before we talk about how you can get started with a meditation practice if you aren't meditating already, let's talk about why meditation is so useful when it comes to financial markets and trading psychology. Reason number 1 is that by practicing meditation, you will get increased emotional awareness. Meditation can help you recognize much more quickly that you are in, for example, in a state of greed or fear. And by recognizing you are in these emotional states, you can use this information to, for example, not enter a trade. But reason number 2 that meditation is so useful, and this is even more important, is that meditation will help you realize that you are not your thoughts. Thoughts that comes when you're trading, such as, maybe I should lower my stop loss, or, maybe I should take profits before my trading strategy says so. With consistent practice, you will be able to observe your emotional reactions without immediately acting on them. This awareness is critical in avoiding impulsive trading decisions based on extreme market emotions. Some other benefits include reduced stress, enhanced decision making and focus, and it can also promote things such as, better sleep and better overall health, which will in turn also improve your trading. So in my opinion, practicing meditation when you're trading is something you can't do without. There are many ways to get started with meditation, but in the beginning you will realize that it's super hard. You can try for yourself to just pay attention to your breath for, say, 15 seconds, and you will realize that even that is very hard without, drifting away with some kind of thought. So in the beginning, I think a very useful tool to get started with, mindfulness and meditation is to use some kind of app that provides guided meditations. And for me, the best meditation teacher I have ever come across is Sam Harris. Sam Harris is so clear in how he teaches. He has, a nice voice, and his guided meditations are just amazing, especially for beginners. So I highly recommend you guys to check out his app. It's called Waking Up. And no, I'm not sponsored by the app in any way. I just genuinely think that it's the best, guided meditations I have ever come across. And it's actually possible to get the app for free if you send an email to their support team. So guys, get started with meditation. I promise you will not regret it. Alright, so rule number 4 is something I can safely say that every single successful trader knows by heart, and that is risk management. Risk management definitely deserves a whole video on its own, and I will definitely make a video about that in the future. So guys, make sure to subscribe if you don't want to miss it. But in this video, I will talk about some of the most important aspects about risk management. So the first thing we need to understand is that trading is often more about limiting the downside rather than maximizing the upside. I've seen way too many examples of traders, you know, having a pretty good win streak only to get completely wiped out by a single trade. For example, when I browsed Reddit earlier today, I stumbled upon this question where a guy wiped out all his gains for this year on one single loss. And the only way this can happen is if you don't have proper risk management. Let's take a moment here and talk about a concept that is very important to understand, and that is risk to reward ratio. The risk to reward ratio is simply how much you risk on a trade compared to how much you win if you win the trade. And as always, I think it's easier to grasp if we look at an example. So for example, if you take a look at this graph right here, where it says risk to reward ratio, when we say that we have a risk to reward ratio of 1 to 1, that basically means that, let's say that we risk $100 on the trade. That means that when we win the trade, we win $100. So pretty straightforward. A 1 to 2 risk to reward ratio basically means that for every $100 we risk, we win 200, and so on and so on. A 1 to 3, we have 100, 300. And this is very important to understand, because let's say that you're using a 1 to 3 risk to reward ratio, right? This means that you can afford to lose 3 trades for every trade that you win and still go break even. So to be a consistently profitable trader, you need to win a little bit more than that. So if you, for example, win 2 trades for every 3 losses, then you are profitable, and you are profitable by quite a bit. So this is important to understand. The next thing I want to talk about here is position sizing, and this is one of the most important concepts in risk management, because this is what prevents you from getting, you know, the type of losses we talked about earlier, the type of losses that destroys trading accounts. So what is position sizing? Well, position sizing is basically how much of your capital do you invest in a single trade. And the important thing here is that you should only risk a small percentage of your total capital on every trade. Most traders recommend that you risk around 1% to maybe 3%, and if you have a smaller account, you might go a little bit higher. But the important thing here is that you always want to have a low percentage, so a single trade just simply can't blow up your account. Let's say that you have an account with $10,000 and you risk 2% of your capital. This is some simple math. That means that you will be risking 200 on the trade. Let's in turn say that you have a 1 to 3 risk to reward ratio. This basically means that you win $600 when you win that trade. The next thing I want to talk about is that you should always set a stop loss. Trading without a stop loss is basically the same thing as gambling. A stop loss is basically a level that when the price dips below, your broker will automatically sell your position. You can also sell your position manually, but I highly recommend to place an automatic stop loss order. Why? Well, this is yet another step that helps you guys to take the emotions out of the market. I also highly recommend to set an automatic order on your take profit level, so when the price goes above this level, you will automatically lock in profits. And this is also important because this helps you take greed out of the equation. Greed can many times be as bad or even worse than fear itself. So now when you have learned about trading psychology, the real education begins. I highly recommend you guys to watch this video about support and resistance next, because support and resistance is a concept that will benefit you no matter what trading strategy you decide to go for. So yeah guys, I hope I will see you all over on that video.